Hello everyone, and welcome to the latest in our 10 Minutes on Tax video series. My name is Donal Thomas and I'm a partner in our tax department. Today we're going to be focused on the whole area of M&A, and so I'm delighted to be joined by my colleague Brian Egan, who's a partner in our transaction services department. It's fair to say that there's been lots of activity recently in the M&A market. To illustrate this, in a KPMG survey, over 50% of respondents said that they expected higher deal activity in 2022, and that follows on from record levels in 2021. So with that in mind, we thought it might be useful to recap on some of the key tax and non-tax issues to consider in the context of an M&A deal. But firstly, Brian, what's deal activity like out there at the moment?
Thanks, Donal. As you said, it's been a really exciting market over the last couple of years. Deal activity has been close to unprecedented, with record transactions in terms of both volume and value in Ireland. That's been driven by huge appetite amongst corporates with cash on the balance sheet to go and do deals, be those large transformational acquisitions or more strategic bolt-on type acquisitions. Additionally, the private equity community globally has an awful lot of capital to deploy and is looking to do that in Ireland, both our indigenous Irish private equity firms and increasingly international firms. All of that competitive tension and all of those additional bidders are driving valuations and valuation multiples to very high levels, so it's a great time to be active in the M&A market. Having said that, the market isn't without some challenge, and clearly some of the macro factors currently at play are going to impact upon the market in time to come. But having said that, we feel there's huge opportunity through 2022 and beyond.
Interesting. Thanks, Brian. So, what are the key tax issues to consider in an M&A deal? Well, firstly, there's the decision as to whether to sell assets or sell shares, and there can be different perspectives on both sides of the deal. There are advantages for a purchaser in acquiring assets, in that they get a step up in tax basis in the underlying assets, and they don't inherit the tax history of the company. However, it is usually more efficient for a seller to sell shares, and whilst it does usually mean lower stamp duty for the buyer, they take on the liability of the company they're acquiring, and that means having to carry out a tax due diligence exercise. Elsewhere, on the sell side, the focus is usually on ensuring you qualify for capital gains tax exemptions and reliefs like retirement relief or entrepreneur relief for individuals, or the holding company exemption for corporates. There are detailed qualifying conditions in each of these reliefs, so care is needed and early engagement is usually important, ensuring you have time to implement any pre-planning tidy-ups you require. There can often be an income tax dimension also for individuals in terms of employment termination arrangements or pension planning. On the buy side, the focus is usually on the due diligence exercise if it's required, and on key tax structuring decisions like the choice of acquisition vehicle and how this should be funded. As to the acquisition vehicle, this is usually a choice between using a personal holding company for an individual, and for corporates, whether the acquisition vehicle should be Irish or foreign. And this itself is usually determined by where the target is located. If debt funding is being used, you're usually trying to ensure you get tax relief for the interest costs on these loans. This is a really complex area of tax law with lots of changes recently, and so early engagement is usually key in ensuring you arrive at your optimal structure. In terms of the due diligence exercise, there can often be issues that arise as part of this on the operational tax side like VAT or payroll tax, or clawbacks triggered as a result of previous reorganisations. Brian, anything else to consider from a wider deal perspective?
Yeah, the M&A process is quite difficult, and processes can be quite lengthy and time consuming. I think that giving a lot of consideration at the outset to information needs, to resourcing and overall preparedness can really set up an organisation for a successful process. Ultimately, management, C-suite and shareholders tend to be very confident in terms of articulating how their business has traded, what drives it and where its strengths come from. But marrying that with robust, consistent data points to really underpin that equity story is a key challenge, and increasingly sophisticated buyers will demand that. Similarly, increasingly advanced data and analytics type tools require data to be of a really high quality, and ultimately that can drive views around the commercial basis of the business and how that's going to drive value. Other areas where we see a lot of development over the last couple of years are around commercial due diligence and ESG due diligence, which used to be seen as an add-on that you might do, but are now seen as an imperative to contextualise how a business performs in context, to put its sector and the country in which it operates into a closer view, and ultimately to underpin the growth story that you're selling through a process. So there's been a huge amount of challenge and a huge amount of change in terms of how we look at these businesses. But ultimately, I think data and preparedness are key to ensure that a process is both smooth and gets to the right outcome.
Thanks, Brian. So then finally, there's the whole area of the transaction documents and the negotiation of warranties and indemnities. Interestingly, we've seen warranty and indemnity insurance policies being used a lot more in the market recently, particularly where there's private equity involvement. This involves an insurer covering a loss as a result of a breach of warranty or a claim under an indemnity given as part of the share purchase agreement. What it means in practice is that what's included under warranties and indemnities and how they relate to the due diligence exercise carried out becomes a core area of negotiation. The key takeaway from all of this for me is that being prepared is really important in ensuring you get an optimal result both from a tax and a non-tax perspective. But it's a really interesting time to be in the market. Please feel free to reach out to myself or Brian if we can be of any help, or your usual KPMG contact. We hope you find this video useful. Thanks for watching, and see you again soon.